Imagine this. A financial advisor who's available 24/7, never takes a vacation, doesn't ask for a bonus, and costs just a fraction of what you typically pay a traditional advisor.
Sounds pretty good, doesn't it?
It really does. And well, that's basically the core promise behind Robo-Advisors. These automated investing platforms, they've actually been around longer than a lot of people realize.
Like the roots go back over 25 years, believe it or not.
Yeah. But they still sort of feel like they're just hitting their stride now, brimming with untapped potential for individual investors.
Oh, absolutely. They've certainly seen some explosive growth in recent years. I mean, from 2017 to 2022, we saw average annual growth rates, well, north of 50%.
Yeah, 50%.
Yeah. And by early 2022, these platforms were managing something like $740 billion in assets.
That is a huge number.
Yeah.
But it's also important context, isn't it, to realize it in the grand scheme of the total U.S. investment market. $740 billion is still, well, it's a relatively small piece of the pie.
It is, absolutely. And while that growth has been really impressive, it's also subject to market realities, right?
Right.
So in 2022, you had challenging market conditions, and that growth slowed down quite a bit. In some cases, assets under management actually receded. It kind of underscores that while the technology is automated, the performance and, investor behavior are still very much tied to the broader economic climate.
That's a really, really important point. So, okay, we have this rapidly evolving landscape, lots of different players popping up. You've got the established financial giants getting in, plus these tech-first startups. If you're up there listening and thinking, could this be right for me? Or maybe, which one should I even be looking at? It can feel pretty overwhelming.
It really can. And that's exactly why we wanted to do this deep dive. We've gathered, quite a stack of source material to try and help cut through some of that noise. We've got everything from a major report that rigorously evaluates the whole landscape and ranks specific services, really digging into players like Betterment and Wealthfront.
Good, yeah.
And then we also have a perspective from let's say, the traditional financial services industry, looking at how regulations might be shaping the future of how advice gets delivered.
Okay, so a few different angles then. Our mission today is basically to unpack all of that for you. We're going to try and pull out the absolute most important nuggets of insight.
Yeah, the key stuff.
The things that really matter when you're trying to understand what these platforms actually offer, how they differ, and they do differ in some genuinely significant ways, and ultimately, if and how they might fit into your personal investment journey.
Right.
We're going to focus on the picture as it looked in 2023, based on the data we have from our sources.
Okay, sounds good. So maybe let's start right at the beginning. What are we actually talking about when we say robo-advisor?
Right, the basics. At their core, they are digital platforms, basically software designed to give you access to diversified, professionally managed investment portfolios.
Okay.
But instead of a human advisor building and monitoring your portfolio, manually, it's done primarily through algorithms, computer programs.
Got it. So you interact with the platform usually through some kind of online questionnaire, right? You'll provide information about your financial goals, maybe you're saving for retirement way out in 30 years, or perhaps a down payment in 5 years, or just, building general wealth. You tell them your time horizon for those goals, and then they'll try to assess your comfort level with market ups and downs, often called your risk tolerance.
And this is actually a key point of evolution, isn't it? Some platforms are moving beyond just asking how you feel about risk.
Yeah, that subjective part.
Right. They're trying to assess your risk capacity, which is more about your actual ability to take on risk based on your broader financial picture. Like, is your income stable? What are your expenses? Do you have an emergency fund? Stuff like that.
Okay, so it's a more objective way to figure out how much volatility your financial life can actually handle, rather than just how nervous you get watching the market.
Precisely.
Okay, so based on all that data you feed it, the algorithm gets to work. It recommends a portfolio mix designed specifically for you, and typically that's composed of low-cost, passively managed investment funds.
Most commonly, exchange-traded funds, ETFs. You hear that acronym a lot.
Right, ETFs. So who are these platforms really aimed at? Who's the target audience?
Well, our sources definitely highlight that the primary target tends to be investors, especially those maybe with more modest means or individuals just starting out on their investment journey.
Younger folks, maybe.
Yeah, younger individuals or people whose financial situations aren't, overly complex yet. The reasons are pretty straightforward. They often have very low or even no required account minimums to get started. The costs are generally much, much lower than hiring a traditional human advisor. And the online interface usually makes them very easy to use, very accessible. So that combination makes them a really compelling entry point into investing for a lot of people.
That ease of access seems like a huge part of their appeal. And while those growth stats we mentioned earlier are impressive, the industry landscape itself is also shifting, isn't it?
It really is.
You see a lot of early providers have actually been acquired by larger established financial institutions.
Right, scooped up.
Yeah. But some of the pioneers, like Betterment and Acorns, they actually started out purely as automated advice services and have, for the most part, maintained that core focus.
Interesting. All right, so that's the fundamental concept. Simple enough on the surface, but as you start digging into the specifics, you quickly realize these platforms aren't just like interchangeable versions of the same thing.
Oh, definitely not.
They differ in some genuinely significant ways that can really impact your experience and, your returns at the end of the day.
That's the fascinating part, I think. It's not just about getting an automated portfolio anymore. The first major area where they really differ is the breadth of services they offer beyond just managing your investments.
Right. It's not just set it and forget it investing for some of them.
Exactly. You see a real spectrum here. On one end, you have basic digital investment management, pretty much just taking your money, putting it into a portfolio based on your questionnaire, maybe with a few simple tracking tools. That's it.
Okay.
But on the other end of that spectrum, some platforms have built out really comprehensive planning tools. They might offer online-only counsel on various financial topics, and some even provide on-demand access to actual human financial advisors.
It's like a hybrid model, almost.
Sort of, yeah. Or at least the option to talk to a human if you need it or want to pay for it. And this range of services is actually weighted quite heavily in one of the big evaluations we looked at. It counted for 20% of the total score.
Wow, 20%.
Yeah, it signals that the platforms recognized as leaders are often providing more than just the algorithm. They're trying to address more of your overall financial picture.
That makes sense. And speaking of what matters in those evaluations, cost is, absolutely critical. It has to be, right?
Huge! Our sources weighted this even more heavily, actually, at 30%.
30% for cost, okay.
And while the median advisory fee for the Robo-Advisors surveyed was around 0.25% of assets per year, which, let's be clear, is dramatically cheaper than the typical 1.00% or even more you might pay for a traditional human advisor.
Yeah, like a quarter of the price, roughly.
Exactly. But how that cost is structured and the total cost you actually end up paying can vary quite a bit between platforms.
Okay, so it's not always just that headline number.
Not at all. That median advisory fee itself, interestingly, actually saw a slight decrease according to the latest data in our sources, which is good for consumers. Most providers charge a fixed percentage of the money they manage for your AUM, assets under management. Sometimes this percentage gets lower as your account balance grows, which is called tiered pricing.
Right, like an incentive for having more money with them.
Precisely. But then you have different models cropping up. Platforms like Acorns and also Betterment, particularly for their smaller accounts, they use a fixed monthly fee instead of a percentage.
Ah, okay. Like a subscription.
Kind of. For instance, Betterment charges, I think it's $4 a month for accounts under $20,000. Now, if you do the math on a $15,000 balance, that $48 a year works out to roughly a 0.32% fee.
Which is actually a bit higher than that 0.25% median you mentioned.
It is, yeah. But it might feel simpler or more predictable for someone who's just starting out with maybe only a few $1,000s. Less intimidating than percentages, maybe.
Predictable cost.
And this is really crucial, something that often catches people by surprise. In most cases, the advisory fee you pay to the robo-advisor does not cover the fees charged by the underlying investment funds themselves.
Wait, really? So there are fees on top of the main fee?
Yes, exactly. Those are separate fees, often called expense ratios, and they're charged by the companies that manage the ETFs or mutual funds the robo-advisor puts your money into. Think Vanguard charging for its ETF or BlackRock for its iShares ETF.
Okay.
These fees effectively come out of the fund's performance before you see your returns. They're deducted from the fund's assets.
So your total cost is actually the robo-advisor's advisory fee plus the weighted average expense ratio of all the funds in your portfolio.
You got it. That's the true cost picture. Now, there are a couple of notable exceptions mentioned in our sources. Fidelity Go and SoFi Wealth, for example, use their own proprietary funds for some of their portfolios, and they actually waive those underlying fund fees.
Oh, So with them, the advisory fee might be the only fee, at least for those specific funds.
Potentially, yes. That's a significant benefit and can lower your total cost considerably, especially compared to platforms where you're paying both.
That's a big difference. Good to know.
Definitely. And beyond those headline fees, advisory and fund fees, there can be other less obvious costs or maybe opportunity costs to be aware of.
Like what?
Cash allocations are a really big one that comes up.
Holding cash in the investment account.
Yeah. If a platform keeps a significant portion of your portfolio just sitting in cash, especially when interest rates are low, that cash isn't invested, it's not growing with the market, and it's potentially dragging down your overall returns.
Why would they do that?
Well, Schwab Intelligent Portfolios is called out specifically in our source for maintaining a consistently high average cash stake, something like 13% on average across its portfolios.
13%. That sounds like a lot to just have sitting there.
It is compared to peers. And the source we looked at actually describes this as a fatal flaw for their core offering. Now, okay, maybe current higher yields on cash might mitigate that drag somewhat temporarily.
Right. Rates are higher now.
But historically, that cash position meant Schwab's portfolios lagged their peers significantly. And importantly, holding that client cash directly benefits Schwab's own banking operations. It provides them with a large pool of very cheap deposits they can use for lending.
So there's a potential conflict of interest there. It helps their bank, maybe not always the investor's returns.
That's the argument, yes. Ally Invest also has a cash-enhanced portfolio option that defaults to a high 30% cash allocation. Though, to be fair, they charge a 0% advisory fee on that specific portfolio, and they explicitly target very risk-averse clients with it.
Okay, so that's more transparent at least.
A bit, yeah. Other platforms might use short-term bond funds or money market funds within the portfolio for liquidity, which is different than just holding raw cash. And then you have platforms like Wealthfront and Betterment, which offer separate high-yield savings accounts through partner banks.
Right, so that's money you choose to keep safe and liquid, completely separate from your investment portfolio managed by the Robo algorithm.
Exactly. It's not a drag within the investment strategy itself.
Got it. Any other hidden costs?
Well, there's payment for order flow. That's where brokers pay the Robo-Advisor firm for routing your trades through them. It's usually a tiny amount per share, fractions of a penny.
Doesn't sound like much.
It's generally not huge for the end investor with robos, especially since they tend towards buy and hold infrequent trading. But, it can add up across millions of trades, and some argue it could potentially create a subtle incentive for more trading, though maybe less relevant for this model.
Okay, so the takeaway on cost is, look at the total picture. Advisory fee plus fund fees plus any potential drag from cash or other structures.
Absolutely. You have to dig a little deeper than the headline number.
Okay. Moving on from cost.
Yeah.
How these platforms assess your risk seems fundamental, right?
Right.
That determines the whole portfolio they build for you. Do they differ much there?
They do, yeah. The standard practice is definitely using some kind of questionnaire. They'll ask about your investment time horizon, when you expect to need the money.
Right. 5 years, 30 years.
Exactly. And your risk tolerance, basically, how comfortable you feel with the idea of your investments potentially losing value in the short term in exchange for potentially higher long-term gains.
The stomach churn factor.
Pretty much. But as we touched on earlier, some platforms like Ellevest and Betterment are noted for shifting their focus a bit. They try to move away from just that subjective feeling about risk towards assessing your risk capacity.
Right, the ability to take risk.
Yeah. They look more at your overall financial situation, income, savings, debts, to determine how much volatility you can actually afford to withstand without jeopardizing your essential goals. Vanguard is mentioned as using scenario-based questions based on third-party behavioral finance research to try and gauge how you might actually react to different market swings.
That sounds more sophisticated than just how risky do you feel on a scale of 1 to 5.
It aims to be, yeah. And then once they recommend a risk level based on your answers, some platforms offer a bit of flexibility.
Oh, you can override it.
Sometimes, within limits. Wells Fargo, for instance, apparently lets you adjust one risk level up or down from their recommendation. Vanguard allows up to 2 levels within their typical 5 risk tiers.
Okay.
Interestingly, Merrill is noted as allowing clients to bypass the questionnaire entirely if they want to.
Really? That seems counterintuitive for a service that's supposed to personalize your portfolio.
It does seem a bit odd, yeah. It kind of defeats the purpose of the advisor part, even if it's a robo.
Okay, so risk assessment varies. Then we get to the actual portfolio construction. What's inside the black box?
Right. So the common ground is that most robos build broadly diversified portfolios. They spread your money across major asset classes, typically U.S. stocks, international stocks, and various types of bonds.
Stuff.
Yeah. And the general allocation shifts based on your risk profile. More stocks for younger or more aggressive investors with longer time horizons, more bonds for older or more conservative investors nearing their goal.
Makes sense, but the specifics differ.
Oh yeah, quite a bit. One difference is just the sheer number of holdings or distinct asset classes they include.
How many different ingredients are in the mix?
Exactly. Some keep it very simple. Vanguard's core portfolios, for example, might use just 4 broadly diversified funds to cover the main bases, though they can build up to 13 funds for more complex client needs or preferences, like ESG.
Okay, pretty straightforward.
Then you have others that are much more intricate. Schwab's core portfolios are mentioned as potentially holding over 50 different funds across more than 20 distinct asset categories.
50? Wow. What kind of things?
Things beyond just stocks and bonds, like gold, commodities, different types of real estate funds, and so on.
Is more necessarily better?
That's the debate. There isn't really a clear consensus, especially for younger investors with long time horizons, whether adding all that complexity actually improves long-term returns significantly compared to a simpler, broad market approach. Some argue simplicity is better.
Interesting. Okay, what else differs in the portfolios?
Fund selection is another key area. While most rely heavily on low-cost third-party ETFs, think Vanguard, iShares, State Street funds, some platforms make significant use of their own proprietary funds. We mentioned Fidelity using its zero-expense Fidelity Flex funds, which is a cost benefit.
Right.
Schwab also uses its own ETFs. SoFi has its own branded ETFs. Citi uses proprietary strategies. Now, while waived fees, low with Fidelity Flex, sound great.
There's a but coming.
Well, it raises a potential question, doesn't it? Is the provider choosing this fund primarily because it's truly the best-in-class option for that specific role in your portfolio? Or is there maybe a potential conflict of interest because using their own fund benefits the company's bottom line, perhaps through asset gathering or if fee waivers eventually expire?
Good point. Builds their own brand and assets.
Exactly. It's just something to be aware of. Merrill, notably, is mentioned as relying primarily on third-party ETFs, avoiding that particular potential conflict.
Okay, what about the overall investment approach or style?
While passive indexing using broad market ETFs is definitely the dominant approach, you are seeing some divergence. Some are adding active management options. Vanguard, for instance, recently added actively managed equity and bond funds as choices within its digital platform.
So not purely passive anymore for them.
Not necessarily. They offer the option. Others might have a noticeable style tilt even within their passive portfolios. So FI is mentioned in one source as having a pronounced growth bias in its stock selection.
Leaning towards faster growing companies.
Right. Whereas Schwab and Betterment are noted as leaning a bit more towards value stocks, companies potentially seen as undervalued by the market.
Interesting. So even the passive portfolios can have different flavors.
They can. And reflecting growing investor demand, many platforms now offer sustainable or ESG options, environmental, social, governance-focused portfolios. Vanguard, Merrill, Wells Fargo are examples mentioned.
Okay, ESG is definitely becoming more mainstream.
It is. Another subtle bias to be aware of is home country bias. Most U.S.-based robo-advisors tend to allocate more heavily to U.S. stocks than the U.S. market's actual weight in the global stock market.
Really? How much more?
Well, globally, non-U.S. stocks make up around 40% of the total market cap. But many U.S. robos allocate less than that internationally. Acorns and Merrill, for instance, are mentioned as specifically targeting a 70% U.S., 30% non-U.S. stock split.
So favoring U.S. stocks, is that good or bad?
It depends on your view. Some argue it reduces currency risk and volatility. Others argue it reduces diversification and misses out on international growth opportunities. It's a philosophical choice.
Okay. And we already talked about cash allocations.
Right. And it's worth reiterating because it's a portfolio construction choice with real impact. Schwab's 13% average cash stake is the prime example of a potential performance drag and conflict of interest.
Compared to Wealthfront and Betterment having separate savings accounts.
Exactly. That's a conscious liquidity decision by the investor, separate from the investment strategy. Holding large cash inside the investment portfolio is different.
Got it. What about things like getting more conservative over time?
Ah, you mean glide paths? That's another sophisticated feature, though still not universally implemented by all robos.
Glide paths, like for airplanes landing.
Sort of the same idea. It's where the portfolio automatically becomes more conservative, shifts more towards bonds and away from stocks as your target date, like your retirement date, gets closer.
Automatic de-risking.
Precisely. Betterment, Wells Fargo, and U.S. Bancorp are mentioned as applying these. Vanguard apparently uses a remarkably precise system with over 300 different glide paths that they update annually based on market conditions and research.
Wow, 300. That's specific.
Very. It shows a high level of sophistication in long-term planning.
Okay, and one last portfolio thing. Rebalancing. How do they keep the target mix right?
Good question. The algorithms constantly monitor your portfolio's allocation. If, say, stocks have a great run and grow much faster than your bonds, your portfolio might drift from its target 60-40 mix to maybe 70-30.
Right. Gets out of whack.
Exactly. So the algorithm will trigger a rebalance. It sells some of the outperformers, stocks in this case, and uses the proceeds to buy some of the underperformers, bonds, to bring the portfolio back to its target 60-40 allocation.
Keeps the risk level consistent.
That's the goal. The triggers for when this rebalancing happens differ, though. Betterment, for example, might rebalance whenever new cash flows come in, like contributions, or if any asset class drifts by more than 3% from its target. Vanguard checks daily, but only rebalances if an asset class drifts by more than 5% from its target.
So different philosophies on how often and how much drift triggers it.
Yeah, minor differences, but they exist.
Oh, okay, that covers a lot on portfolios.
Yeah.
Now let's talk about something really important, especially for people investing outside of retirement accounts like IRAs or 401ks. Taxes.
Yes, tax management. This is where some robo-advisors can potentially add significant value, particularly through tax loss harvesting.
That's loss harvesting, TLH. Explain that again simply.
Sure. TLH is a strategy specifically for taxable brokerage accounts. It doesn't apply to tax-advantaged accounts like IRAs. It involves intentionally selling investments that have gone down in value to realize a capital loss on paper.
Okay, selling losers. Why?
Because you can use those losses to offset capital gains you might have realized elsewhere, maybe from selling winners. This reduces your taxable gains. And here's the key benefit. If your losses exceed your gains in a given year, you can use up to $3,000 of those net losses to directly offset your ordinary income, like your salary income.
Wow, reduce your regular taxable income.
Yep, up to $3,000 per year. And any losses beyond that $3,000 aren't wasted. They can be carried forward indefinitely to offset future capital gains, or up to $3,000 of income in future years. It essentially defers taxes and can provide a real boon to your after-tax returns over time.
That sounds pretty valuable. Do all robos do this?
No, and that's a critical differentiator. Betterment is often cited as a leader here. They have an advanced algorithm they call TLH+, which runs daily and actively looks for opportunities to harvest losses, potentially generating significant tax savings, especially for people in higher tax brackets.
Okay, Betterment is strong there.
Vanguard only rolled out TLH relatively recently in late 2022, but they now offer it. However, and this is crucial, some very significant players completely lack this feature. Fidelity Go is a prime example.
Fidelity Go has no TLH, even with its low fees.
Correct, no TLH. Marcus Invest from Goldman Sachs, Merrill Guided Investing, and Citi also reportedly lack TLH capabilities. So if you plan to have a significant taxable investment account, the presence and the sophistication of the TLH feature is a major consideration. It could easily outweigh small differences in advisory fees for some investors.
That's a huge point. But isn't there some rule about selling and buying back too quickly?
Ah, yes. You're thinking of the wash sale rule. This is where tax loss harvesting gets a bit tricky. The IRS rule states that if you sell an investment for a loss, you cannot buy back that same security or one that is substantially identical within 30 days before or after the sale. If you do, the tax loss you claimed is disallowed for that year.
So you can't just sell Apple stock for a loss today and buy it right back tomorrow to game the system.
Exactly. The Robo-Advisors algorithm needs to manage this. When it sells an ETF for a loss, it usually buys a different but highly correlated ETF tracking a similar index to maintain your market exposure without triggering the wash sale rule. Then, after 31 days, it might swap back to the original ETF if desired.
Okay, that makes sense, but where does it get really tricky?
The complexity spikes if you hold similar or identical investments across multiple accounts, especially mixing taxable and tax-deferred accounts like a 401k or IRA, and maybe managing them separately.
How so?
Okay, Imagine your robo-advisor sells, say, a Vanguard Total Stock Market ETF, VTI, in your taxable account to harvest a loss. That's fine. But TA, maybe in your work 401k, which the robo doesn't manage, you also hold the Vanguard Total Stock Market Index Mutual Fund, VTSAX, essentially the same thing, tracking the same index.
Right. Common fund.
If your regular 401k contribution, or maybe an automatic dividend reinvestment in that VTSAX mutual fund, happens within that 30-day window, before or after the VTI sale in your taxable account, you could accidentally trigger the wash sale rule across your accounts.
Whoa, even though they're different accounts and slightly different fund types.
Yes, because the IRS considers them substantially identical. You'd lose the tax benefit of the loss harvested by the robo in your taxable account. This is a real risk if you're not careful or if your robo doesn't coordinate across all your holdings.
That sounds like a nightmare to track manually.
It can be. Betterment claims its algorithm attempts to manage this globally and avoid wash sales if they are managing all your relevant accounts, both taxable and tax-deferred. But if you have outside accounts, especially with similar holdings, it's a significant risk.
So the sophistication of the TLH matters, including how it handles potential wash sales across accounts.
Absolutely. Some sources suggest that holding an ETF tracking an index in one account and a mutual fund tracking the exact same index in another might technically avoid the rule according to some interpretations, but others advise extreme caution. It really highlights the complexity and the value of a robo that truly understands and navigates these rules effectively.
Okay, TLH and wash sales, super important for taxable accounts.
Yeah.
Are there other tax features?
Yes. Beyond TLH, tax efficiency can involve things like tax-efficient fund placement. This means strategically putting investments that tend to generate a lot of taxable income each year, like certain types of bonds or REITs, inside your tax-advantaged retirement accounts, like IRAs, where that income isn't taxed annually. Conversely, more tax-efficient investments, like broad stock index funds that mostly grow via capital gains taxed only when sold, might be prioritized for taxable accounts.
Smart allocation across account types.
Exactly. Also, how the platform handles initial transfers of assets can matter. If you're moving an existing portfolio with big embedded capital gains, some platforms might be better at transitioning those assets gradually to minimize the tax hit. Vanguard, for example, is mentioned as having improved its onboarding process for this.
Okay, what about retirement withdrawals? Do robos help with tax-efficient ways to take money out?
That's generally an area where most pure robo-advisors are still less developed. Their target audience historically has been younger people in the accumulation phase, saving and investing. Complex retirement withdrawal strategies, like figuring out which accounts to draw from first to minimize lifetime taxes, are typically more the domain of traditional human advisors or more specialized planning software right now.
So maybe not the best fit if your main goal is planning retirement income streams.
Not usually their core strength, though some are adding more features. Another related feature is outside account aggregation. Several providers like Betterment, Empower, formerly Personal Capital, Vanguard, Schwab, Wealthfront, and others offer tools that let you link and view all your financial accounts, banking, credit cards, mortgages, outside investments in one place.
Like a dashboard for your whole financial life.
Exactly. It doesn't necessarily manage those outside accounts, but it helps you get a clearer overall picture, which is valuable for planning and tracking.
Okay, that's a really comprehensive breakdown of the ways these platforms can differ. It's definitely not one size fits all.
Not even close.
So now that we've got those key differentiating factors in mind, cost, services, risk, portfolio, taxes, let's maybe look at how some specific well-known providers actually measured up in the evaluations we reviewed. Where did they land?
Sounds good. Based on the main source that did a rigorous ranking using weighted criteria, remember, 30% price, 20% quality of investments portfolio, 20% breadth of services, and other factors, Vanguard Digital Advisor came out right near the top. It received a high ranking, scoring 4.8 out of 5 overall.
4.8? That's impressive. Why so high?
They scored highly across pretty much all categories. Vanguard is consistently praised for its incredibly low total cost. The combination of their advisory fee, which starts around 0.15% or 0.20%, plus the very low expense ratios of the underlying Vanguard funds they primarily use, it often sums up to a total annual cost around just 0.20% or even slightly less for larger accounts.
That is really low compared to the median 0.25% advisory fee plus fund fees elsewhere.
It offers significant value on cost alone. Plus, they now offer a wider range of strategies than they used to, including those active management options and ESG portfolios we mentioned. They provide advanced tax efficiency, including that relatively new TLH feature.
And the robust risk assessment with all those glide paths.
Exactly. And being part of the larger Vanguard ecosystem with its vast resources and research likely boosts their score for breadth of service too, even if the digital platform itself is somewhat focused.
Okay, so Vanguard looks strong. Who else ranked well?
Fidelity Go was ranked above average with a solid 4.0 out of 5. It also scored well across the board.
And their big draw is the cost for smaller investors, right?
That's definitely one of its most compelling aspects. That's 0% advisory fee for balances under $25,000 is huge for people starting out. Above that, the fee jumps to 0.35%, which is a bit higher than the median, but still reasonable. And remember, they use those proprietary zero-expense Fidelity Flex funds.
Right, so no underlying fund fees, which keeps the total cost low, even for balances above $25K, where the advisory fee kicks in.
Correct. Fidelity Go is also noted for having good customer support. However, the major drawback we already flagged is that complete lack of tax loss harvesting.
Yeah, that's a big gap for taxable accounts.
It really is. It's probably the main reason it doesn't rank even higher, despite the cost advantages.
Okay, so Vanguard high, Fidelity Go above average. What about some of the other really big names people hear about, like Betterment and Wealthfront?
Right, the original independent pioneers.
Right.
They both landed squarely in the above average tier as well, actually tied for 4th place in this particular ranking, both scoring 3.5 out of 5.
Okay, 3.5, still above average. Betterment first, why wasn't it higher, maybe?
Betterment, despite being a pioneer, actually saw its ranking drop slightly in the latest evaluation compared to previous years. One reason cited was their decision to add more speculative investment options, specifically cryptocurrency portfolios.
Crypto.
Yeah. While they apparently suggest limiting allocation, the source viewed adding access to such volatile and frankly expensive crypto products as adding unnecessary risk for a service that's supposed to provide core long-term investment management.
Kind of straying from the main mission.
Perhaps, cost-wise, Betterment uses that tiered or monthly fee structure, 0.25% of AUM if you have over 20K, or that fixed $4 per month for smaller accounts. They also have a premium tier, which gives you access to human advisors for planning topics, but that comes at a higher fee, 0.40% AUM, or you can pay hourly, like $399.
Okay. And remember, their advisory fee is separate from the underlying fund fees.
Correct. Those average around 0.11% on top of the advisory fee. So the total cost is more like 0.36% for the standard tier above 20K.
So higher total cost than Vanguard or Fidelity Go. What are its strengths then?
Betterment's portfolio construction is generally well regarded. They use glide paths, focus on tax efficiency, and its real standout feature, the one proponents argue can justify the higher fee, especially for high earners with large taxable accounts, is that advanced daily TLH plus algorithm.
The tax loss harvesting.
Yes, potentially generating significant tax savings that could outweigh the advisory fee. They can also manage IRAs alongside taxable accounts, and they offer that separate high-yield savings account option.
Okay. Downsides noted were the crypto edition and the separate underlying fund fees. Anything else?
One other small point mentioned is that if they manage your tax-deferred accounts, like an IRA, you're paying their advisory fee on those assets too, where TLH isn't relevant. And managing traditional IRA assets with them can complicate doing a backdoor Roth IRA contribution strategy because of something called the pro-rata rule, which might be relevant for high-income earners.
Niche point, but important for some. Okay, what about Wealthfront? Also 3.5, tied with Betterment.
Wealthfront has a simpler fee structure, just a flat 0.25% advisory fee, similar to Betterment's main tier. Underlying fund fees are separate here too.
Okay. How does it compare to Betterment?
Wealthfront is highlighted in the source as potentially having an edge over Betterment, specifically in portfolio customization and offering more advanced investment strategies, but primarily for higher net worth clients with taxable accounts.
Advanced strategies like what?
Things like direct indexing, owning individual stocks instead of an ETF to enhance TLH, smart beta strategies, and even risk parity portfolios. These are more complex options, typically requiring larger account balances.
So maybe more appealing for wealthier, more sophisticated investors using a robo.
Potentially, yeah. They also include tax loss harvesting, which is essential.
Yeah.
However, where Wealthfront was seen as falling a bit short compared to some competitors like Betterment or Vanguard was in the breadth of comprehensive financial planning features.
Oh, like what's missing?
The source noted a relative lack of integrated tools for things like aggregating all your outside accounts onto their platform, sophisticated planning tools for multiple goals simultaneously, or easy, on-demand access to human advisors for planning questions. It's more focused on the investing side.
Got it. More investment-centric, less holistic planning focus than some others.
Yeah.
Okay, one more in that above-average tier, Schwab Intelligent Portfolios. Scored 3.6, just slightly ahead of Betterment Wealthfront.
Right. Schwab actually received a high score specifically for its breadth of service category. This was largely driven by its premium tier offering.
Ah, the one with human advisors.
Exactly. It requires a higher minimum balance, $50,000, I believe, and there's a one-time $300 upfront planning fee, plus an ongoing 30-month fee. But for that, you get comprehensive planning services and unlimited access to certified financial planners. CFPs. That's a significant human touch point.
That does sound comprehensive.
Yeah.
What about their core automated offering, the non-premium one?
Schwab's core Robo Intelligent Portfolios famously has a 0% advisory fee.
0% sounds amazing. What's the catch?
Well, this is where we come back to that fatal flaw highlighted quite strongly in the evaluation, that consistently high average cash allocation around 13%.
The cash drag.
The cash drag. While current higher interest rates might temporarily mask the impact, historically, this large cash holding has caused Schwab's portfolio performance to significantly lag behind peers who keep cash allocations very low, like 1% or less. And as we discussed, it primarily benefits Schwab's own banking operations by providing them with cheap deposits.
So the 0% fee isn't really free if the cash drag hurts your returns more than a fee would have.
That's precisely the argument made in the source. It's a major point of criticism and something anyone considering Schwab needs to be very aware of and comfortable with. They do offer a wide range of asset classes in their portfolio construction, and they include tax loss harvesting for accounts over $50K. But that cash drag is a significant factor that impacts its overall assessment, despite the 0% advisory fee and strong premium offering.
Okay, so a real trade-off there with Schwab. Did the sources mention any platforms that ranked lower? Maybe just briefly why?
Yeah, they touched on a few that landed in the below average or even low tiers. Often it came down to a combination of factors. For example, Titan Invest was ranked low. It was cited for having high costs, both advisory fees and high underlying fund fees, and using quite volatile strategies, including crypto, plus lacking core planning features like tax advice or management.
High cost, high risk, low features. Got it.
E-Trade Core Portfolios, now owned by Morgan Stanley, was ranked below average. Reasons included middling fees, 0.30% advisory plus fund fees, limited features like no integrated goal planning across accounts, no easy access path to human advisors, and apparently some features were even removed after the Morgan Stanley acquisition.
Yep.
Merrill Guided Investing from Bank of America Merrill Lynch also landed below average. Criticisms included higher tiered fees, especially for smaller accounts, limited access to planning services unless you have much higher assets, a very short and potentially inadequate risk questionnaire, and some issues with portfolio transparency.
Doesn't sound great.
UBS Advice Advantage and Ally Invest also scored in the lower tiers, generally for similar reasons: high costs, limited features, lack of transparency, or in Ally's case, that high default cash allocation in their cash enhanced option, and just generally not keeping pace with adding common features like TLH or account aggregation.
Okay.
And one more worth mentioning is Empower Personal Wealth, which many people know from its previous name, Personal Capital. They offer really strong digital tools for tracking net worth, and budgeting that part is often free and highly rated.
Right. The free dashboard is popular.
Exactly. But their actual investment advisory service was rated below average in this robo context, primarily because it comes with relatively high fees compared to robos, starting maybe around 0.89% and tiering down, and requires a significant minimum investment, typically $100,000.
So really targeting a wealthier segment.
Yeah, it's more geared towards the mass affluent or high net worth market, competing more with traditional advisors than with the low-cost robos we've been focusing on.
Okay, that gives us a really detailed picture of the robo-advisor competitive landscape based on that specific evaluation.
Yeah.
Lots of variation. But you mentioned our sources also included a different kind of perspective, something broader about the financial advice world.
Yes, exactly. This other source is quite different. It's a report that was commissioned by the Financial Services Institute, or FSI. The FSI is a major trade association representing independent financial advisors and independent broker-dealer firms, basically, a large part of the traditional human advisor industry.
Okay, so a perspective from the established players.
Right. Now, the report itself was written back in 2017, specifically in response to a controversial regulatory proposal from the Department of Labor called the Fiduciary Rule. While that specific rule has gone through many changes since then, the report offers really valuable insights into the concerns held by parts of the traditional financial services industry about how certain types of regulation could potentially impact the future of financial advice delivery for everyone, including how robos fit in.
So, looking at the potential impact of rules on the whole ecosystem, what were their main concerns?
Well, from the FSI's perspective, as presented in this 2017 report, that particular fiduciary rule would have had significant negative consequences, as they saw it, for both financial firms and ultimately for individual investors.
Okay, how so?
One of their primary arguments was about the huge increase in costs that firms would face. They projected substantial one-time implementation costs and significant ongoing compliance expenses, billions of dollars for the industry as a whole.
Billions, wow.
Yeah, and they argued these costs would inevitably be passed on to investors, either through higher fees for advice or by firms reducing the range of services they offered to control costs. They also highlighted a significant perceived risk of increased litigation stemming from the rule structure, adding further potential cost burdens.
Okay, so increased costs leading to higher fees or fewer services. What else?
A major point they raised, and this ties directly into our discussion about robo-advisors, was the potential for reduced access to personalized financial advice, particularly for smaller investors.
How would the rule reduce access?
The report suggested that under the cost pressures and compliance burdens of the proposed rule, many firms might find it simply cost prohibitive to serve accounts below a certain asset threshold, maybe accounts under $20,000 or $50,000, or perhaps even as high as $100,000 would become unprofitable for them to handle with personalized human advice.
So smaller investors might get dropped by their advisors.
That was the concern expressed in the report. From this viewpoint, it could lead to smaller investors essentially losing access to the valuable personalized guidance, the relationship, the behavioral coaching that human advisors can provide. They might be pushed towards purely automated solutions like robo-advisors, or find it much harder to get access to basic financial education and comprehensive planning assistance.
And the argument is this disproportionately impacts
Precisely those individuals who might need advice the most to get started, to build savings habits, and to plan effectively for long-term goals like retirement, people who aren't wealthy yet.
Okay, that's a significant concern about access. What else did the FSI report argue?
They also argued that the rule could lead to less product choice for investors. Their reasoning was that firms facing increased compliance scrutiny and litigation risk would likely narrow their product offerings. They'd favor simpler, standardized mass appeal products like the passive index funds commonly used by robos because they are easier to supervise and defend.
Okay.
This might mean less access to more specialized funds, alternative investments, or complex products like certain types of annuities, even if those products might be suitable or beneficial for specific investor situations. The report basically viewed this as the regulation creating an unintended bias towards passive investing, potentially distorting the market and limiting legitimate investor choices.
A narrowing of options.
They also pointed to the pressure the rule would create for firms to shift their business models away from commission-based accounts towards fee-based accounts, where the advisor charges a percentage of assets, like robos do.
What's wrong with fee-based? Isn't that often seen as better aligned?
The report argued that commission-based models, where the advisor is paid per transaction, can actually be better or more cost-effective for certain types of investors, particularly those who trade very infrequently, or those with smaller account balances, where an ongoing percentage fee might be more expensive over time than occasional commissions. They argued that forcing a wholesale shift to fee-based models would harm these specific investors.
Okay, so arguing for the validity of different models for different needs?
Right. They even expressed concerns about the rule creating challenges for new human advisors trying to enter the field and potentially causing existing advisors to spend much more of their time on compliance paperwork rather than actually working directly with clients on achieving their financial goals.
More bureaucracy, less advising.
That was the fear. So bringing this back to robo-advisors specifically, how does this FSI perspective frame them?
Yeah, how do robos fit into this picture?
From the viewpoint presented in this FSI report, robo-advisors are essentially framed as an alternative solution, maybe even a less desirable one, that smaller investors might be forced into if regulations make personalized human advice too expensive for firms to provide profitably to them.
So robos as a consequence of regulation pushing people out of human advice.
That's the implication. The potential loss is seen as the personalized guidance, the relationship, the behavioral coaching that human advisors have historically provided, particularly in helping people navigate complex situations or stay disciplined during market volatility. The report explicitly stated its view that the rule mistakenly favors the automated robo-advice model over traditional human advice models.
Okay, so a very different take on the rise of robos compared to just seeing them as a technological innovation offering lower costs.
Exactly. And it's really crucial here to understand this FSI report represents one specific viewpoint. It's the perspective of the traditional, independent human advisor industry, focusing on the potential negative impacts of certain regulations on their business models and on their clients' access to their type of advice.
Right, important context.
It stands in pretty stark contrast to the perspective presented in those robo-advisor evaluations we discussed earlier, which naturally highlight the benefits of automation, things like the lower costs, the easier access, the systematic approach that robo-advisors provide, especially opening up investing for people who couldn't afford or access traditional advice before.
So, two sides of the coin, really.
Definitely. Both viewpoints offer valuable context on the complex forces and debates shaping the financial advice world today. It's not just about technology, it's also about regulation, business models, and who gets access to what kind of help.
Okay, wow. So we've done a really, really deep dive here. We've gone from the basics of robos through all the ways they differ, looked at specific players, and now this broader regulatory context. After digesting all of that, what does this actually mean for you, the listener? If you're wondering about automated investing, what are the absolute key takeaways to pull from all this?
Yeah, let's try to synthesize it. I think the first big one is recognizing this kind of paradox. Robo-advisors aim to offer a streamlined, simplified path to investing, right? That's the promise.
Easy button.
But the process of choosing the right robo-advisor for yourself is actually anything but simple. The landscape itself is complex, and you really have to look closely at the details. Don't just grab the first one you see.
Okay, so step one is, don't assume they're all the same. Do your homework. What's step two?
Cost. Cost is undeniably a major advantage they generally offer compared to traditional human advisors. That much is clear, but you absolutely have to remember that the advertised headline advisory fee is just one piece of the puzzle.
Right. Total cost matters.
Your total cost includes that advisory fee, PLO US, the underlying fund expense ratios. A&D, you need to consider potential hidden costs or drags, like a large cash allocation. As we saw, Vanguard and Fidelity Go, especially for balances under 25K, really stand out for their low total cost structures in the evaluations we looked at.
Okay, look beyond the headline fee. What else?
Features. Features truly matter, and different platforms clearly prioritize different things. You need to figure out which features are important for your specific situation. The biggest one is probably tax loss harvesting.
Yeah, that seemed crucial.
If you have a taxable brokerage account or plan to have one of significant size, TLH should absolutely be a major factor in your decision. As we saw, platforms like Betterment and Vanguard are strong here, offering sophisticated TLH. Others, like Fidelity Go or Merrill, offer literally nothing on that front. That's a massive difference.
And if you only invest in retirement accounts, like an IRA or 401k,
then TLH is irrelevant for you. It doesn't apply in those accounts. So you might prioritize other features instead, maybe lower fees, sophisticated planning tools, or access to human advice.
Speaking of which, do you think you might want access to a human advisor, even just occasionally, for trickier questions or reassurance?
Right. If that's important to you, some platforms offer it as an add-on or in their premium tiers like Betterment Premium or Schwab Intelligent Portfolios Premium, or Wells Fargo has options. If you're perfectly happy with a purely digital experience and don't foresee needing human help, then that opens up other choices.
Okay, features based on your needs, then understanding the portfolio itself.
Yes, absolutely. Understand what's actually under the hood. Are you comfortable with a very simple broad market index approach like Vanguard might offer? Or do you want exposure to more niche asset classes like commodities or gold, which Schwab includes? There's no single right answer. It's about your preference and belief.
Then the style tilts.
Yeah. Does the provider's underlying investment philosophy, like SoFi's apparent growth tilt or Schwab and Betterment's value leanings, align with your own preferences or views? Or do you want pure, plain vanilla market tracking? And critically, be aware of potential issues like Schwab's significant cash allocation and understand how that might impact potential returns compared to peers. Don't ignore that detail.
Okay, so it really sounds like the punchline is there is no single best robo-advisor out there.
Absolutely not. That's probably the most important takeaway. The best choice is deeply personal. It depends entirely on your specific financial situation, your unique goals, your time horizon, your tax situation, and what you value most in a financial service.
So you need to match the platform to yourself. Can we get some examples? Like if you're just starting out.
Sure. If you're just starting out, maybe with a relatively small amount to invest, you'll definitely want to look for platforms with low or no account minimums. And pay close attention to the fees on smaller balances. Fideligo's 0% advisory fee under $25K makes it incredibly compelling for beginners, despite its lack of TLH. Other platforms might have that fixed monthly fee, like Betterment's 4-month, which could be reasonable too.
Okay. What if you have a taxable account, maybe a bigger one?
If you have a sizable taxable account, then the presence and, frankly, the quality of the tax loss harvesting feature becomes a major factor. You'll need to weigh the potential tax savings from TLH against the advisory fee charged. Platforms like Betterment, with its advanced TLH plus O, or Vanguard now offering TLH, become very strong contenders in that scenario, even if their fees aren't zero.
Right. The tax savings could be worth more than the fee. What about if you're focused on retirement?
If your primary goal is long-term retirement saving, look for platforms that offer solid planning tools geared towards that. Features like glide paths that automatically de-risk your portfolio as you approach retirement can be really valuable. Vanguard and Betterment were noted for having these. But also be aware, as we discussed, that most pure robos don't yet specialize in complex retirement withdrawal strategies. If you're nearing or in retirement, you might need more specialized advice.
Okay. And what if you have a more complex financial life, maybe higher assets?
Well, for very complex situations or very high assets, a dedicated human advisor might still be the most suitable choice. However, some robo-advisors are moving upmarket or offering hybrid solutions. Wealthfront's advanced features like direct indexing cater to higher net worth taxable accounts. Schwab Premium offers that unlimited CFP access. And platforms like Empower are specifically designed for the mass affluent, combining technology with dedicated human advisors, albeit at a higher cost.
So options exist even for more complex needs within the robo or hybrid space.
They do, yeah. And finally, just maybe keep that broader regulatory context in the back of your mind. The concerns raised in that FSI report, whether you agree with them or not, serve as a useful reminder that external forces, government rules, industry economics can influence the evolution of the financial advice market. These forces could potentially impact the accessibility and cost of different types of advice and products in the future, both human and digital.
Right. The landscape is always shifting.
Always. So, stepping back one last time, what are the biggest lessons we learned from this whole journey through robo-advisor land?
Well, for me, it's clear they offer undeniable advantages. They've brought low-cost, professionally managed portfolios within reach of millions more people, which is fundamentally a good thing for financial access.
Totally agree. But they are absolutely not commodities. They are not interchangeable.
Far from it. They differ significantly in their fee structures and, more importantly, their total costs. They differ in how they assess your risk, which is foundational. They differ in the specific portfolios they build, the number of funds, the style tilts, how they handle cash.
They differ hugely in the crucial tax management features they offer, especially TLH. And they differ in the range of broader financial planning services and human support available.
So the absolute key lesson, the thing you really need to take away, is that you must look beyond the simple advertised percentage fee.
Yes. Understand the full package, dig into the underlying costs, evaluate the features that matter for you, understand the investment approach being taken with your money. The best choice is the one that aligns most precisely with your individual financial situation, your specific goals, and what you need.
Okay, before we wrap up, here's maybe a final provocative thought to leave you with. It's something that financial firms, tech companies, and regulators are all grappling with right now.
Okay, lay it on us.
As artificial intelligence and automation in finance continue to get exponentially more sophisticated, will digital advice, maybe today's robos or their future AI descendants, eventually fully replace the need for human financial advisors?
The big question.
Are there fundamental aspects of financial planning, things like behavioral coaching, helping you navigate the intense emotions of market downturns, providing genuine empathy during major life transitions like job loss or inheritance, or structuring truly unique, complex financial situations that only a human can genuinely provide?
That human touch, the nuance, the relationship.
Exactly. And maybe a follow-up question. As this landscape continues to shift, What happens to the investors who might fall through the gaps? Maybe people whose situations become too complex for a simple robo-advisor, but perhaps they don't have enough assets to meet the high minimums for traditional human advice, especially if regulations, as the FSI feared, make serving smaller clients less economical. Who serves them?
That's a critical question, isn't it? Ensuring access to quality advice for everyone, regardless of their wealth level or the complexity of their situation, as the models evolve. It's a huge challenge for the future of how people will get the financial guidance they need.
It certainly is. And on that thought-provoking note, that wraps up this deep dive into the world of U.S. robo-advisors. We have covered a lot of ground today.
We really have.
From breaking down how they work and all the crucial ways they differ, costs, services, portfolios, taxes, to spotlighting some specific providers based on those evaluation rankings, and even looking at the broader regulatory forces at play. Hopefully, this gives you, our listener, a much clearer picture of the landscape.
Yeah, hopefully it helps you think more critically about whether automated investing is the right path for you personally.
And if it is, how to make a truly informed choice based on what actually matters for your circumstances, not just the marketing hype.
Until our next deep dive.
Keep asking questions, keep learning, and keep digging for knowledge.